Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Wednesday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from a beautiful and sunny Denver, Colorado today, as usual on Wednesday. Pleased to be joined by my friend and fellow coach, Brent Moores. Good morning, Brent. Good to see you again. How are you?
Hey, I'm doing good. I'm glad to be on with you, Kevin, and I'm glad you're back in town after going to New York and Chicago. You're like a world traveler here right now, but we're glad to have you back as well too.
Yeah, you're right. Good to be back. Jet setting all over the place. Get a little bit of a break in between now and our next event in DC next month, but plenty of opportunity to engage with all of you over the next few weeks. I will put a reminder out there for you, everybody. If you're wondering about those live events, hit up the Schwab.com coaching zone to make sure that you're aware of where we're going to be between now and the end of the year, so you can attend some of those workshops or market drive events that we've got coming up. We'd love to see you out there, everybody. Brent and I today are joined by our friend Barb Armstrong in the chat. So say hey to Barb. She has recently returned from her brief hiatus. I say brief, I'm sure it was lengthier for her as she was in recovery mode, but we are so pleased to have Barb back for us. So she will manage chat today, getting to questions that Brent and I are unable to get to, but please feel free to post. For the duration of the show, we'll go about 45 minutes in total. And if you're not already doing so, the three of us would greatly appreciate a follow on X. Kevin Horner CS, Brent Moores CS, and Barb Armstrong CS is where you can find us outside of the classes that we host for you here. It's a great way to engage with us, everybody. We'd appreciate a follow there. All right, let's get to our disclosure so that we can dive into things as the market is moving. So first and foremost, remember that our conversation is exclusively informational and educational. We do not make recommendations nor endorsements for a specific approach to trading the market. Additionally, we cover technical analysis in this class. We discuss concepts and strategies traders may choose to employ, but it's important to remember that technical analysis is merely one piece of the puzzle, and we do not encourage you to base your decisions exclusively off technical analysis. All right, Brent, in terms of our agenda, it's going to be more of the same, right? We're going to start top down, looking at the broadest of indices, working our way through sectors that are on the move. And we've seen some shifts in the market of late that are going to be notable as it relates to these sector movements, sector relationships, and so forth. So we're going to try and cover the picture there as broadly as we can and set the table for the remainder of the day. So Brent, let's get right to it. Let's look at that S&P. We did have a pretty good pullback yesterday, and yet no matter the amount of negativity you might feel as of yesterday's close, for example, not just yet have we had much of a breakdown in terms of the trend.
Correct. Yeah. If you look back at the pullback we've had the last few days, compare that to pullbacks we've had along the way since April, I guess, early April. It doesn't seem anything out of the ordinary there, Kevin, in terms of that regard. I mean, yesterday it was a big day down, but we're still above the 20-day moving average. We're still there. So I don't see anything super game changing about yesterday's move here. It is interesting. You can see that RSI. We have that nice lower high on that RSI down there at the bottom of the page as well. But our trend is going strong. One other thing I would note here. What are your thoughts on the SPX here?
Well, I totally agree. I mean, obviously there's a bit of a pullback. Which is all we've done, right? Off of the highs, having gone really nowhere but to the 20-day. And really, we haven't even tested that just yet. A lot of traders would say we're waiting for that. Do we actually test down there? But some bulls are going to point, or more specifically, bearish traders are going to point to that declining in the RSI as the heads up that something bigger might be under the surface, though, Brent. We do have a bearish divergence after we made that last high.
That is a divergence. And just to clarify for everybody, what that means is, during the time we got a higher high on the index, the SPX index at the top of the chart, those peaks, the highs, the corresponding highs on the RSI were lower highs. And how that is interpreted sometimes is that could be a sign of a weakening of the market. Now, most people don't just trade exclusively off divergences and say, oh, well, I had a bearish divergence, therefore I'm just going to go all in negative on the market here right now. But it is a cautionary note for traders.
Yeah, exactly that. Let's try and remind ourselves that divergences like this don't necessarily mean the end of any rally or push to the upside. It is not a wonderful development, and yet it could just mean the pause that we've undertaken in the last 4 to 5 sessions here. By no means does it mean we have to break down. Now, if we break down and we see a significant pullback, Brent, it's not uncommon for us to, instead of finding support in the vicinity of my rising 50-day moving average, which is today at 62.54, this ledge beneath us, right around 6190 to 6200, seems to be pretty important. We've tested this level a couple of times, and it's not uncommon to find support at a horizontal level after breaking a trend line like the 20 or 50-day.
Yeah, and I mean, that wouldn't be that unreasonable of a pullback here at this point if we were to go down there. Now, we would be a little bit uncomfortable if we got there because we'd be breaking the 20-day and the 50-day moving average. But, given how far we've come from the beginning of April, I don't know what percent that is, but a pullback along the way of a few percent wouldn't be, look, I mean, we're up 32% from that date, and it was at its peak up to 34%. So having that coming back a few percent, that's not that would not be out of the ordinary or anything like that.
Yeah, exactly that. I'm trying to paint some context to the move.
Yeah,
Is really important here. Now, there's another level that we could retreat to, Brent, that might make a lot of sense. And I'm bringing this up again because not from the standpoint, Brent, of what's developing under the surface or the reasons for traders to be concerned. I'm not here to put fear into traders. What I am here to do is aid our traders in managing their own individual portfolios and positions. And one of the key levels that I found, Brent, was actually these prior highs, right around 6,100. Reminder that when we find prior highs and break through, former resistance can then become important support for us. Well, one of the things I like to do, as everybody who's a frequent attendee knows, we like to look.
I knew where you were going with that, Kevin.
I had a feeling you knew as a frequent joiner of my classes, Brent. So I wanted to draw this from our bottom, our trough, to our peak. And this is making the assumption that our recent high is the high for the rally. So please don't make this assumption either. But the reason I'm bringing it up is you'll note, Brent, that this 23% retracement coincides beautifully with those prior highs. Now, the only reason I'm suggesting this is because we traders, we tend to stay optimistic. We tend to believe that what I define as support is where we're going to fall. And then the fall will stop at what I think is support. And commonly, Brent, that's not the way it works. We often fall through levels of import to the shorter term trader. And that happens because so many traders are watching the same levels, Brent. So many traders are going to have exit strategies around those same levels, and it can lead to a cascading effect lower occasionally. So we need to be prepared for moves that take us below what we deem to be the most important area of short-term support. And I bring this up because if we don't conceive of those levels becoming a possibility, Brent, then we can stay over invested and uncomfortable when things do pull back.
Absolutely. That is certainly a possibility. A 23% fib retracement is it's a common level that people look at here on this. So would not be shocking if we did that. But who knows? I mean, right now, the trend has been up. It's been going up, and we're still above that 20-day. Let me point out one other thing here I found kind of interest, and you may have to zoom in just a little bit on the chart to see this here, because I want everybody to see yesterday's candle here. Yesterday's big red candle yesterday, right? That's on the SPX. Now, look at the SPX EW here. This is the equal weight SPX, and let's look at that same candle on the SPX EW. Do you see that? It's a green candle there on that SPX EW. So yesterday, big sell-off in the market on the SPX Actually, if you look at the equal weight on that SPX, on the S&P 500, it was up. There was the breadth was marginally positive yesterday on that market. That means it was driven down by a lot of, and we'll look at some of these names as we go later on in this session. But when when you have an Nvidia, which I'm not even sure what percent of the SPX is, but when that was down, what, 3.5% or something like that, I think yesterday, and some of these bigger names, which just got kind of crushed yesterday, that dragged the whole SPX down, even though the SPX, EW, equal weight, seemed to be doing just fine, actually.
It's a really good reminder, Brent, because I think what we're going to find is that as we move through our broad look at things here, there has been a little bit of selective selling, and that's not uncommon, especially when we've got rallies that have been selective in nature too. We'll look at some of those groups in particular. I know you all are familiar with which ones we're talking about. We'll start with the NASDAQ 100, which has broken the 20-day, Brent. So once again, looking at the groups that have provided leadership, technology, NASDAQ 100 heavy, obviously in tech. This is looking a little bit different. Now, we did make that rally when we broke the 20 last time and made a new high, but again, divergent high. So that calls out to us a little bit. And the potential exists that we are getting a little bit of a rotation after such a fantastic upward move in the NASDAQ. We remain, even at our lows today, up about 40% from the lows there in April, and about 45% up from our lows in April when we peaked just last week.
Yeah, we'll have to see where things go with this. But, when things generally in the market, when there's a security or index that tends to go up faster, i.e. the NASDAQ here in this case, for example, they tend to fall faster when they do decide to fall. Now, it's not the end of the world here. We had a similar pullback a couple weeks ago, but it's, we have several levels of support we can hit. You have that 50-day moving average, which it seems like a reasonable level there that it could go down to. We have your horizontal line, the prior highs, and you could go through and draw a Fibonacci on this one too, and have similar target levels here to look at. And it could bounce at any of those, and that 23% line spot on with what we have on here. And it could bounce elsewhere too. It may blow through all those for all we know.
Sure could. And that's exactly what we want to point out. Technical analysis doesn't predict what's going to happen in the future. It just allows us to manage our risk properly. Keep that in mind, everybody. Now let's draw a little line to get an idea, Brent, of how far we're talking. If we were to find, instead of the 50-day, my ledge of horizontal support, it would be about another 2.75% from where we are. If we found the 23% retracement, it'd be about a 4.5% pullback further from where we've been. So about 6 to 6.5. Not a huge pullback, but completely within reason. The problem becomes those bigger those pullbacks of standardized levels, 4, 5, 6%, very standardized. And yet, if we're overinvested, it can become uncomfortable. And that's all we want to speak to, is how we traders are going to manage our individual positions for comfort, so we can handle all of this machination if that's what we're going to get.
Yeah, and those pullbacks, 4, 5, 6%, remember, keep them in context. We are up 40%. What was it on the NASDAQ here from those April lows? So if it were to fall 4 or 5%, I can guarantee, like, a lot of people here listening would be very, very nervous about their portfolios, about the market. It's just, I see this over and over again, and it's important to step back and go, hey, look, just a few months ago, I'm up 20% from where it was a few months ago. That's not the end of the world here.
That's true. Context is super important, Brent. As is, there's a great question in here about utilizing moving averages, different moving averages. Brent, consistently in this one, we rely on the 20, the 50, and the 200-day simple moving averages. But I often state that it's not so important that we use a specific moving average, but rather we follow the one that is being most respected by the index that we're looking at or the stock we're looking at. Do you feel like that's as important as I do?
That's key, because I think in the chat, give credit here to Stephanie saying, "Hey, look, a lot of different instructors use different moving averages." Yeah, there's no one right moving average out there, and so how do you know which one to use? Well, I'd echo what you said. Number one, that is, use what has been most indicative of the market move. And two, use something that makes more sense for the time frame of investing that you're looking at. If you're a longer term trader, you're likely to you may look at some shorter term moving averages, but you also may give some priority to a longer term moving average. A longer term moving average would be, I'd say, something 100 days or more on that.
Sure.
But one of the things we can use moving averages for, they're versatile. You can use them to try and help you identify trend. They can help you identify support and resistance levels as well as if you're going real short term, you can even look at them as potential momentum. But for the most part, when we're talking about support and resistance, absolutely what you just mentioned, and that is, what has it used in the past and bounced off in the past, with the assumption that that may be more likely to be a support or resistance level in the future.
Great reminder there, Brent. Now, as we see here in the NASDAQ, breaking the 20-day, hopefully a single day again, but the possibility exists for a deeper pullback. Let's look at what's going on in our small caps. Now, our leadership to the downside has been NASDAQ. We are going to hit up a few of these other important areas, but we've noted that there's been some real leadership actually out of the small caps of late, pushing upward into resistance. Brent, are you at all surprised by the level to which we rallied and then took our breather?
No, because that's where from a technical standpoint, that's where a potential resistance level was. And that's often, not always, that's often where you see a breather. But just because we're having a breather doesn't mean, that's more of a flag, it appears to me, than anything right now. And the trend has been stronger. And, when we talk about small caps, we always think, well, what's the forecast for interest rates and whatnot? Well, I think people are more optimistic that we're going to see lower interest rates, and that could be in part driving these small caps lower. Probably less concern about pure recession in the economy, which can be helping small caps there. But just from a pure technical level, I think that level that we bounced off of may make sense on that. And as you're pointing out right there at the bottom of the page, with a little bit of a divergence there on the RSI as well on small caps, just like we saw on large caps too.
Yep. Yeah, that's there's apt to be a bit of a rotation underway potentially here, which is, as I stated, we're going to continue to kind of eyeball. But this is a new short-term high. That is the highest close we have seen since all the way back in December of last year. So this was notable development. The pullback to be expected after a nice rally into an area of resistance. Let's see if the 20-day provides support or if we need to test the 50 once more. It seems like the 50-day here in pink has been the more notable. In the longer range, we've been a little more working our way through the 20-day to the downside more frequently. So some would say that the 50-day may carry more import here now. And then I'll just lastly call out the 50 rising through the 200 to the upside. That's not a bearish indicator, but rather a intermediate term, intermediate to longer term view of a positive indication, Brent. So let's not get too negative off of what we've seen thus far.
Yeah, I'd agree with that. When we're looking at technical analysis, for a lot of traders, the trend is king, I guess. And right now that trend is not broken.
Yep. I think that's the takeaway for now. Let's peek in on those semis, off 1.7%, making a pretty healthy pullback now, Brent, after a break to the upside. Looks more like a head fake, than anything else, doesn't it? Like a fake out breakout, as our friend Pat Mullally used to say. We've pulled back to the 50-day moving average. We've actually tested it intraday right now. But Brent, this has been underway for a while because we've consolidated in here nicely, but we've now seen that the RSI is not just making lower highs. Today, we've made a lower low in the RSI. We need to keep a close eye on this.
Yeah, we haven't broken the 50-day yet. We haven't broken the lows of a couple weeks ago yet. But few cracks showing up in the SPX here right now. So, we'll have to see on that. It is interesting when we talk about semiconductors, because they're in the news a lot right now. And not only Intel, which, at one point was the biggie name in semiconductors, isn't the biggest name anymore. But lately, the last couple of weeks, it's gotten the most attention because of a potential government plan to buy equity, or to have equity in the Intel stake, a stake in Intel. And now they're floating the idea, I guess, there's the possibility of other semiconductor stocks, the U.S. taking equity in other semiconductor stocks as well, as a part of the money that they've given out for the CHIPS Act. The government would be taking non-voting shares of several different semiconductor manufacturers here. It's not a done deal, but that's what the reporting is, that a possibility is. And I think Howard Lutnick mentioned something to that effect. So that's kind of the macro news, or just the general news that is driving semiconductors the last few days. But from a technical standpoint, that's a pretty substantial pullback. We're seeing down 2% today after, about a 2% pullback yesterday, I think, too.
Yeah, it's fair to mention all of the commentary that you highlighted. Very important to recognize. Intel did have a positive reaction initially before the market got a little bit negative yesterday in the afternoon. There's another question in here. One I want to address real briefly, just real quickly for RTR. DMA I'm commonly referencing as daily moving average. So when I'm looking at a daily chart, the 20 DMA is the 20-day moving average. On a weekly, it would be, WMA, weekly moving average. But simple moving average versus exponential, SMA versus EMA. Some traders prefer exponentials. You get a little heavier weighting on your most recent price activity, but it can also lead to more false signals. So you need to be aware of that. But that's, again, a preference for traders. I often like to call it trader's choice as it relates to that. Carol's asking about rotation, noting that all the indices are going negative. Where's this money going? Well, Brent, let's look at these groups that are moving here. Now, it's one thing to think of rotation from a standpoint of the S&P, the NASDAQ, and the Russell. But when we talk rotation, it isn't on those broader indices. It's on the 11 sectors of the market. That helps us understand where money is held, where money is moving. And we can lead with tech. Technology being our biggest move to the upside here, of course, as a sector. This is giving a standard pullback at this moment. Yes, it broke the 20, but now we are closing in on potentially the 50 and former horizontal support. So, Brent, talk to us a little bit about rotation and maybe what we're in the midst of witnessing here.
So what we're seeing is IT, which has been the biggest driver pushing the market up, has been falling a little bit. And it's the biggest influence on the SPX as a whole. Communication services, big influence on the SPX as a whole. That's been falling as well. The SPX falls. There's a lot of sectors, though, that are actually doing fairly well right now, but they're not the heavyweights. It's like you have a team, a basketball team or something. When you have one star player that's having a poor game, maybe you're less likely to do well in that game. But even though maybe some of the other players are doing fairly well still. So when you consider the weighting, in fact, maybe you could bring up the heat map there, Kev, real quick.
Yeah, sure.
On this, and just if you pull up the S&P 500, here's the S&P 500. Do you see on the heat map? There's green and there's red, and it's also broken down into these sectors. If you look at the area that is devoted to the kind of the amount of real estate, so to speak, devoted to information technology and communication services, that's between those two. That's, I don't know, not quite half, but pretty close to half of the whole S&P 500 out of those 11 sectors there. So, but you can look at those green areas. Right now, Staples, nice green day on Staples. Energy, nice green day on, and healthcare, with the exception of Eli Lilly, looks like nice green day. So that's some of the rotation there that we're seeing right now.
Absolutely right. And you're not shocked, Brent, are you? Because when you look at those groups, those are commonly referred to as defensives, right?
Yes.
Staples, defensive in nature. Real estate, utilities, defensive in nature. Healthcare, defensive in nature. Not uncommon for us to witness these types of rotational moves out of what was working into what is lagging. And that's kind of what we're getting at here, Brent. So let's take a peek. Let's go back. We've seen the tech pulling back. We've also seen communications pulling back. Why is that? Well, we know the biggest players in communications. That's your Alphabet, that's your Meta, that's your your big companies and the biggest leaders, if you will, right? Now, look at the ones that are providing some level of leadership today. Staples up 1.3%. Looks like a bit of a move to the upside, but it's still kind of rangy. Healthcare is kind of notable, though, Brent, because we have been dancing in this range for a while now, and now suddenly working its way out of this range. Now, we are still in a fairly long range downtrend, as you can see on the weekly chart, but healthcare is working to make a bit of a correction here. And I'm also going to point out that rising RSI as price has gone sideways can be a little instructive for the bulls, can't it?
Yeah, kind of the opposite of what we were been talking about when we were talking about the SPX, the lowering RSI as a sign of maybe some potential a turnaround that way. This is looking at the other way. This is maybe more of a bullish sign, and you can see this has kind of been reverse the fortunes almost, not exactly, but of what the S&P 500 have been, and that it's really struggled for a while. And the question is, are we turning around on that? And so you can view the market in longer term, intermediate term, shorter term. Shorter term, looking a little bit more bullish here. We'll have to see if the more the intermediate term trend there, as you can kind of see represented by, I guess that's, well, you could see that 200-day moving average there.
Yep.
Kind of, so are we going to bang up against that there before too long? We'll see. That's a little bit above where we're at right now. We also have some highs that we've hit off that we're kind of encountering right now. We'll see if we can break through. There's a fair amount. I mean, between the horizontal resistance, the diagonal resistance, the 200-day moving average, there's a few little hurdles in the way, so to speak, on the healthcare sector. But you know what? If we have a true sector rotation, then we may go right through those.
And I think that's just a reminder, Brent, is we can, it's a pullback in the broader market, but there are pockets of green, and that heat map can do a really good job of illustrating it. If you're struggling to see it through the breakdown of the sectors, everybody, don't hesitate to use that heat map to really be instructive for you. All right, let's look at that VIX. I know a lot of you are wondering what's going on with the VIX. We're seeing a bit of a lift in the VIX. Brent, this is not at all uncommon. We're getting some protective placement by larger institutional investors, some would say, but we've been languishing for a while. And Brent, for the last few weeks, I've been mentioning the possibility of complacency. This as volatility falls, one thing we expect is volatility to return or revert to the mean at some point. And there's a level that we've come down to around 14.5. And that level has been an area where spikes in the VIX have come back into play here. So hopefully that has been heated and traders have been tightening up stops along the way to mitigate their risk factors. But what are you paying attention to as we watch the VIX here at this point?
Yeah, no surprise that it's gone up a little bit here on the VIX. Just look at the level. Look at the level we're at. We're at about 16 to 17, which is, given the time span. Look at the last year. You can see, well, that's kind of, I don't know. It's kind of I'd say a median level almost maybe right now.
Yeah.
On where we're at. Obviously, you wouldn't call it an average necessarily because we had the huge spike that occurred in April, and it would take probably some significant doings to get the VIX above 30. That's not, hopefully we don't see that, because that would mean the market's probably taking a pretty good tumble at that point here. But the odd thing about the VIX has been it's been pretty low. I mean, we've been below 15, and there's still been a lot of concern in the market, a lot of uncertainty in the market. And it seems like the uncertainty that was in the market, which in past times probably would have maybe spooked the market a little bit, and we'd see higher VIX levels. The market was kind of going, well, this is the norm. This is like the new norm, uncertainty regarding trade and tariffs and things like that. The market's kind of become acclimated to it, and it just keeps going up. And that's when the market's going up, you see the VIX is usually pretty low. So we'll see what happens. There's certainly a high correlation or a high inverse correlation, I guess I should say, between the VIX and what the S&P 500 does. But I don't know where it's going to go from here. But this spike is totally normal. One thing we know about the VIX is, if you look at the past, at least, I guess I can't guarantee anything for the future, but when it goes real high, it tends to revert back down to a lower level. And when it gets low for quite a while, it tends to spike up occasionally. And that's what we're seeing right now.
Yeah, it sure looks like it. So we'll see if this starts to make its way higher. You can expect to get obviously a little bit more volatility, a little bit more selling perhaps, but we are going to be getting some FOMC minutes, Brent, where we got Jackson Hole on deck. There's always the possibility for, pardon the expression, a little bit of fireworks in the market with commentary and headlines. So we have to be aware of that. And it wouldn't at all shock me, Brent, if traders in the deep pocket institutional traders were simply positioning to manage that volatility here in the short term as a protection. Again, we often see VIX pull spikes like this in the midst of upcoming known events, and that's not at all uncommon to witness. So we're not going to overthink it. We're going to continue to watch the trends that have been managing or working the most. But I do think it's notable as we look through the groups that are providing some leadership and some support to the broad market today. It's some of these that are interest rate sensitive and some that have been a little bit lagging in the broader move we've seen recently. Brent, before we move off into stocks in the news, is there any of these other groups you want to hit on from the sectors today?
I just point out that we have we're going to hit this with stocks in the news, I guess, in terms of like retail. So you can look at like Staples or discretionary and their performance. A lot of this is ahead of earnings here on this, but these are going to be in the news here on this, and in terms of what they're doing. And so, I mean, the trend has been pretty strong. A little pullback today on discretionary. And I don't know. I mean, we're still above that 20-day. Remember, you can use that 20-day kind of as a gauge. If we're above the 20-day, the trend has been pretty strong, probably.
Yeah, and we see Staples reacting favorably, taking on some of that less risky money. Traders moving out of maybe a little bit of tech in favor of Staples to that extent. Now, discretionary is where you will find home builders, and I saw an inquiry there just real briefly. I thought we could hit up the home construction to validate some of this look, Brent, we've managed to push home construction up to some new levels. But I think part of that has had to do with the movement in the 10-year rate, which has pulled back to a more manageable level of late. I guess the question becomes, if we in fact get rate cuts, as is widely expected in September, as opposed to during Jackson Hole, I would not expect to see anything out of schedule, Brent. But if we in fact get rate cuts, the question remains: are we going to move? How are the rates going to move after that? Because the last time we got a cut, we saw a big rally in yields.
Right. We don't know. It could absolutely go opposite. But the general sentiment, I think, in the market is, hey, there's likely to be more home construction. You saw this, by the way, in the Berkshire Hathaway purchases last week. I think they were announced, of Lennar and D.R. Horton. And, you know, the feeling is, not only are people who are kind of have been stuck in their existing mortgages, they're not going to move and get out of a real low mortgage rate. But the feeling is, well, you know, at some point, life's going to go on and people are going to move. And of course, you have newer first-time home buyers that are going to perhaps be entering the market on a little bit of a downtick. And I think maybe there's a realization that the longer term mortgage rates, you know, they may go lower, but we're not going to get to levels like we saw 5 years ago on those either. Furthermore, there's also the other factor. It's not an interest rate factor as much as there seems to be a housing shortage out there in terms of number of houses out there. And if you're optimistic about more home building to address that shortage, home builders are likely to be the beneficiary there. And you see people, even before the houses are built, in anticipation of that, you see home builders outperforming right now.
Mm-hmm. All right, Brent. So we've got about 7 minutes or so left. Let's hit up some stocks in the news. We had some upgrades and some downgrades. I wanted to hit one of those downgrades that might catch some eyes. It's on Applied Materials. Unfortunately, this one, they waited for the earnings and then they downgraded, of course, after a fantastic move off of lows. And you've got a complete breakdown here, unfortunately. They were downgraded by Daiwa to neutral from outperform. New target is down from 185 down to 170 after the company reported a good quarter but offered weak guidance as they await approval of China licenses, according to the analysts. So this unfortunately has the making of what appears to be more of a breakdown than anything else.
Yeah, that's a significant breakdown. Sometimes when we're looking at an upward trend and we're going, well, is it really breaking or not? It becomes questionable. This one's not really questionable. When you get that big a break, that uptrend is broken on that one there. So Applied Materials, which is a semiconductor equipment supplier, getting hit pretty hard here.
They are. Now, there's interesting development from Citi, because as we were just talking about discretionary broadly pulling back, we're down 1.3%. Citi went through and downgraded a number of these discretionary companies in retail space. So let's look at Abercrombie and Fitch. Citi downgraded A&F here to neutral from buy with an unchanged price target at 105. The firm is more cautious on specialty apparel heading into the second half.
Yeah, it'll be interesting to see, because they have earnings coming up here before long, how the stock reacts to earnings in light of the downgrade here. We've taken a little pressure, so to speak, off the balloon, I guess, there in terms of the stock before earnings. Maybe expectations are going to be a little bit lower on that, but it'll be interesting to see if we were to get a big jump on earnings after the downgrade. Kind of a funny scenario there.
Yeah, for sure. The other one, a couple of other ones actually. Let's make sure we get them. We had a same thing from Citigroup on Gap. So Gap had been downgraded to neutral from buy. Price target at 22, down from 30, which is a pretty significant development. Kind of stuck here beneath that 50-day moving average, Brent.
Yeah, so it wouldn't be surprising. I mean, it's actually relative to the market is actually holding up fairly well given the downgrade there on that. So, but it seems Citigroup may have a not an optimistic view of what earnings are going to be. Of course, nobody knows exactly what earnings are going to be on this, so we'll have to wait and see.
Yeah, of course. Another one, same space, Urban Outfitters. Let's take a look there. Downgraded by Citi to neutral again. Target here is at 76, slightly different. Apparently, I've been watching this one, Brent. The level that we fell to there, not so notable. So I'm going to lift my Fibonacci's. I've got a bull flag that did play out bullishly eventually, but this one's really trying to figure things out, isn't it? I mean, it seems to me if I was going to pick on a level of support, it might be something like, in this area. It's which it has come to a couple of different times, but that's from a kind of a horizontal area. What are you seeing?
I'd agree with that support level. When you have kind of this island sitting up there, we had a gap up there. That the lower levels of that can act as a support level. So, and if we were to break below that support level, from a technical standpoint, that'd be a very bad sign for that company. The theory being it could easily kind of pull back down to the areas where it traded pre-gap up there back in, the last earnings report. So we'll see what this earnings report does. But this is a stock that, unlike the others we were looking at there, actually is really getting hit pretty hard today here. I don't know if that's solely for the downgrade or what, but certainly this is going down more than the average stock on the market right now.
You're right. And again, we'll just call out that all of these have been in advance of expectation of earnings, which they're stating is expected to be favorable according to Citi, and yet concern for forward-looking guidance is where Citi's kind of hanging their hat on these downgrades. One more downgrade is in the grocer space. Kroger gets a downgrade today from JP Morgan to neutral from overweight. Target here is $75 as they assume coverage on the name. So the firm decided to cover 24 stocks in food producers, food retail, and ag products sector. They list McCormick's, the Spice Group, as their top one in that group, along with Albertsons ACI. But they downgraded on Kroger specifically. So wanted to make sure I posted that. Brent, it's kind of difficult here to find a whole lot of a pattern. This range has been maybe the most important range, and we're just about in the middle of it or approaching the upper level of it.
Yeah, and that gap on Kroger about a week ago occurred after Amazon announced they were going to be increasing their fresh grocery delivery offering there. And Kroger got whacked on that one there. So it was starting to get out of line there above its channel line and just got pushed back down into that channel area.
Now, there are two upgrades in this similar area, Brent, I thought we could touch on here in companies that you might not be looking at necessarily. But what about J.M. Smuckers that was upgraded by JP Morgan, overweight from neutral, price target at 129, up nicely from 102. A little bit of a recent development, at least in terms of the trend here, huh?
Yeah, nice trend. It's using that 20. So when we talk about which moving averages to pay attention to, right now the 20-day would be, because we've skimmed right above that, and it seems to be acting as a support, shorter term support, and that'll at some point it will break it in the future. It won't always stay above its 20-day, but right now that seems like the most likely level of support.
And then Hormel in the same space, JP Morgan giving you an interesting look, not a chart that's necessarily trending, but when you pay attention to the level that it had been trading at around 28, working off of that, you certainly could suggest that there might be something under development. Looks like there's resistance up there in the neighborhood of these prior highs. So something like 31.5 or so as an area for potential upside if we're just going to break through some of those major moving averages. So that one seemed notable. And then I picked on McCormick's a minute ago. They also got the upgrade there with JP Morgan to overweight from underweight. Target on McCormick is 83. This one looks a little different though, Brent. This one's trading really close to those lows, isn't it?
Yes, it is. And it'll be interesting. We're right. That 20-day was kind of acting as a resistance. We're right above it here. We opened up higher today, up a couple percent today. We'll see where we hold up throughout the rest of the day on that, if we can stay above there. But right now, the shorter term trend is not good on McCormick.
You know, there's been an interesting development just throughout the whole market review we've offered today. Obviously, things are a bit under pressure. Let's make sure that we're addressing the individual stocks within our portfolios to ensure that we're comfortable with what we're maintaining long. I know that the pullback here, if you've been aggressively long and not building cash, has been difficult. So make sure you're considering the levels beneath that we could always fall to. Always good to be managing our individual positions to our comfort. Brent, I want to thank you. Lots of good discussion today, man. I think we covered quite a bit, but as always, I love hearing your insights, and thanks for sharing them with our viewers.
Hey, thanks for having me on here, Kevin, and we'll looking forward to be back on next week.
Yes, we will. Big thanks to Barb managing the chat there today, everybody. Please follow the three of us on X. If you like the discussion today, hit that thumbs up button down below for us as well. Always appreciate you joining and participating, everybody. Have a fantastic rest of your Wednesday. We look forward to seeing you again here real soon.